Welcome to presentation number 10 from Cash Club. We're glad that you guys can make it, especially because of the recent coronavirus outbreak. But we figured that we would virtualize some of these meetings in order for you guys to take advantage of Cash Club despite the isolation. So welcome to presentation number 10. It'll be presented by me, John, in addition to Rishi from the Point of West branch. And today we'll be discussing the topic of private equity.
Make sure to join the investor game for both the All Branches game as well as the game for your school. The winner at the end of the semester of the All Branches game will receive a cash prize.
So let's get started with the basics.
Let's begin by understanding the main differences between private equity and publicly traded assets. Private equity includes investments that are not on the public exchange. This means that there are usually a smaller number of investors that invest from a private firm. Private equity means a direct ownership in a privately listed company. For the company, this means they can raise capital for their operations and expansion. Hopefully, the goal is to go public one day. On the other hand, the goal of the private equity investors is to sell the equity once improving the company, or sticking to the company's growth as a major shareholder. Companies such as the Blackstone Group would invest in private equity, where they try and find smaller companies, improve their operations and efficiency in order to sell them to larger companies and gain profit from the exchange, or become large shareholders in the smaller companies and gain money when the smaller company goes public. On the other hand, publicly traded assets are almost always stocks. They are generally safer than private equity since they usually involve a larger number of investors. It's public, so it's available to a wide range of investors. Anyone can trade publicly, from regular people to investment banks such as Goldman Sachs. Investment banks also often help companies go from private to public, which happens in an IPO, or initial public offering, where a company that was initially private goes public and makes its shares available to a larger number of investors. Since publicly traded assets involve a lot more people and a lot more investors, they generally are less risky, and private equity often takes more skill in valuing a company and improving the company in order to be sold in the future.
So let's take these principles Rishi just discussed and implement them into a case study. We've actually taken a case study by a lot of articles from Harvard Business School, and this is similar to what they do at Harvard Business School, and they look at specific companies and really dive deep into what they're doing. So for Dell, let's talk about Dell. When Dell went private in 2013, after about 25 years as a publicly traded company, the founder and CEO, Michael Dell, who actually went to UT Austin, by the way, where he founded the company, Michael Dell borrowed money and enlisted a leveraged buyout specialist called Silver Lake Partners, which is basically a private equity firm, to facilitate the deal. As a result, Dell doesn't have to please an impatient shareholder group anymore by offering a dividend, and the newly private company doesn't also have to repurchase its own stock in order to affect its stock price in the open market. Basically, for Dell, they are more free to do what they please and focus on making the company better as a whole, on their own plans, basically. So for Dell, they needed to do this because at the time, or not at the time, back in the early 2000s actually, they were the leading company in manufacturing PCs. Of course, everyone had a Dell at the time. Dell laptops were all the rage. But by 2012, the company was having a lot of trouble with a lot of improved competition, such as PCs from companies like HP and Apple. They ate up a lot of important market share. And new mobile devices like iPhones and iPads were making personal computers more and more obsolete and less worth the cost. So Michael Dell decided to fight for a privatization because he thought it would help the company. Although he did run into a lot of disagreements with the board at Dell, he did succeed eventually in taking the company private, and he bought back public shares at about $14 a share. And in that period, when Dell was private, they were able to bring back the company to a more stable footing, and they were able to really focus on making the products better, like the XPS line of computers, in addition to expanding more profitable venues such as services and software. And In 2018, there is a success story here. Dell did return as a public company with a $34 billion listing, and you can also trade it publicly now today and on the investor app.
If you want to be a part of the Cash Club team, apply now as an outreach associate for Cash Club. In this role, you'll be tasked with expanding our organization, either by introducing a new branch to our network of investment clubs or by bringing donations for the nonprofit side of our organization.
So if you ever find a time and you want to work on your investment knowledge, feel free to visit our website, cashclubcorp.org. We're planning on posting a lot more stuff on our blog, in addition to more even virtualized guest speakers that we're working with. And feel free also to follow us on Instagram at cashclubcorp. And we're posting a lot of stock market news in addition to even giveaways and stuff. So just stay tuned.
Thanks for watching, everyone, and stay safe.